I'm going to navigate over now to the PowerOptions suite of tools. Of course, we're going to use the PowerOptions tools to help us illustrate the responses of your questions as well. Okay, there we go. So what we're looking at here, of course, is the basic 14-day free trial setup for PowerOptions. For those of you just getting started, I encourage you to take advantage of the 4 steps that are listed here. You can access the free Quick Start Guide at any time. There's a variety of flash tutorials to help you get more familiar with the tools on the site. You can access the webinars at any time, either our upcoming live presentations or, of course, just linking over to the free webinars tab here. You can go through the various archives that we have for the PowerOptions tools, options strategies, tips on managing positions, rolling and adjusting positions, and more. Options concepts, just some basic thoughts on weekly options, fixing your broken stock or broken position, exercise versus assignment, and more. And of course, all of our standard open discussion presentations, whether they be Friday or our special editions when the market's closed on Friday, you can access in the requested topics. This is a public page, powerop.com/webinars.asp. You can access it at any time without even being logged into your PowerOptions account, or if you're even considering a trial and want to review what the tools can do for you, you can access these at any time. And of course, want to remind everyone, those of you that are on a trial or are current subscribers to PowerOptions, step number 4, you can schedule that coaching session at any time. That's a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have related to options investing, PowerOptions as well. All right, so all that being said, we've got a couple questions that have come in. I want to remind everyone, of course, send me a question at any time during the webinar using the question pod. All right, let's see, here's Richard. Richard's first question is, looking at the weekly spread searches, why are we going 14 days out in time instead of looking at the current week? Great question, fair question as well. So as you see here up at the top on PowerOptions, I have a variety of different strategies selected: covered call, long call, bull put, credit spread, calendar call, and more. If you don't see a strategy that you want, well, it's probably there. Let's just click on the Other Strategies tab, and you can pick and choose which strategy tabs you want available for your personal account. But for Richard, let's go into bull put, credit spread, and let's go into the search tool. This is where we can identify positions based on our default criteria, or you can create your own search based on your needs in a specific strategy. Now, as you see here, here are current results for the default weekly bull put credit spread. Actually, what I use in my personal account, usually open 2 spreads or so Monday or Monday afternoon for the next week out. But to Richard's question, what you can see here is that we're looking for positions that are 8 to 17 days out in time. Why am I not looking for something that expires this Friday or 7 days away from now? Well, the reason why is that using our backtesting tools, we ran a variety of iterations for different option criteria, probability, minimum net credit, strike difference, in combination with what stock technicals seem to work best using Bollinger Bands, moving averages, MACD, and more, with, of course, which stock fundamentals worked best to meet our needs. What we found is that long-term, over different testing cycles, basically we've tested all the years with this criteria from originally from about 2014 all the way through to 2018 and more, first quarter of 2019. And what we found is that if you want to look for a good probability, which we found worked best, 85% or higher that the spread would expire worthless, looking for the same positions that would have matched this stock and option criteria, lowering the net credit a little bit, but going only 5 days out in time for the shorter time frame, the results long-term or lower than going 14 days out in time. Why? Well, part of the reason why is that if I go shorter term, let's just say I looked for next week's expiration, 8 days, 7 days out in time, or on a Monday I opened a position that was 5 days out in time, my net credit wouldn't be 30 to 40 cents using that 85% probability and going further out of the money. Net credit was closer to maybe 8 cents, 7 cents. Now, it doesn't sound too bad. You say, hey, I can just make it up by trading more contracts. But with using a 2-point spread or 2.5-point spread or a 5-point spread, if you're only collecting 8 or 9 cents, eventually you will have losses. It's inevitable. Yes, we're looking for 85% probability. Yes, this search criteria has shown us about a 92% success rate over time in multiple years. But let's just take this Children's Place bull put credit spread, stock at 111, 15 days out, we've got a 103-101 spread with an 85.3% probability of expiring worthless. Let's take a look at the profit and loss chart. Now, sorry folks, with credit spreads, yes, they involve risk. They're a risky strategy in the sense that the risk-reward ratio here is usually about 7 to 1 or 8 to 1. That's what you expect looking for that 85% probability or higher. The max loss, which we never want to take, in this case is about 180, and the max profit's about 23 cents. So we're close to an 8 to 1, 9 to 1 risk-reward ratio. That doesn't sound too fantastic. But again, that's why we're going out of the money and looking for the better probability of this expiring worthless, in conjunction with the other stock criteria we tested as well for better success. This is still a 13% return over a 15-day period. But let's change our structure. Let's look for the 103-101 strike for the next 5 days, 7 days out in time, not for the May 1st or May 3rd expiration, excuse me, but for April 26th. So let's clear those out. We'll go to April 26th expiration. Okay. Oh, there we go. I apologize for that. Oh, that's strange. I apologize, ladies. 1 second, 1 second. Here we go. Okay. Let's get back to square one. We're going to look at the bull put spread for 103-101. And we're going to use the midpoint prices. Okay, so let's clear out our original one. And instead of having a 23-cent net credit with these strikes, we're looking at about a 2 or 3 cent net credit. Now that's not going to solve our needs, is it? Why? What we found out going shorter term is, unfortunately, eventually, you're going to have a position, a bull put spread, that goes against you for near the maximum loss. Uncertain market conditions, think about February 5th to February 9th of last year, that complete volatility spike and when everything collapsed. Or October 5th through October 10th, when that first decline started, recovered a little bit in November, and then went down to the bottom of 2018 in December 26th. On the first day of February 5th, I had 2 bull put spreads open. After February 5th, where they were near profitable in the morning, then the market collapsed. At the end of the day, they were both near an 80% loss. When you go 5 days out, looking for shorter term, hoping to have less of a chance of the stock going against you, you take a lower net credit naturally, but that means you also take a higher risk. So when you have one loss go against you, you might wipe out 20 or more previous successful trades. But if I'm going 2 weeks out, getting 20, 25, 40 cents of net credit, one loss on the 2-point spread might only wipe out 7 or 8 previous positions. So that's what we saw historically going through time is that the weekly options that were just 1 week out in time, when one loss went against you, it wiped out more of your previous wins, and it was harder to get that back over time, even if you had an 85 or 90% success rate. So Richard, to answer your question, based on historical testing and performance over multiple years, we've found that on average, the 2 week out spread positions were more successful than trying to force it just 5 days out in time, accepting a lower net credit, still getting a good leverage return, don't get me wrong, and still having a high probability. But when you did suffer a loss and it happened quickly for an unexpected event, that lower net credit means that full loss wiped out more of your previous success rates, and it was harder to get back to break even. And long term, the 2 week out ended up having a better track record. All right, so that's why when you see the weekly bull puts, weekly bear call credit spreads or more, we're looking for the positions 8 to 17 days out in time rather than the standard weekly. Now, let's get to the main crux of that. This isn't to say that you cannot be successful trading weekly spreads. Okay, there's a lot of times when you can be successful doing 5-day out trades. What you're going to want to do, though, is adjust the criteria so that it makes sense. So how would I do that? All right, well, as I mentioned, we'll just change our days to expiration. We'll use the default search criteria here for bull puts as a stepping stone. And we're just going to change our expiration to 0 to 8 days, I guess we need out in time, for next Friday the 26th. I'd like to see net credits of 20 with a probability of 85. There's probably some that match that. Let's check. So before I do anything, I'm just going to run that search for the next cycle out in time. This is what we figured. It's not that there aren't bull put credit spreads that expire. Oh, maybe it's 9 days. Let's try 9 days just to make sure, just to be safe. But this isn't telling me that there's not bull put credit spreads that expire April 26th that don't have an 85% probability. What it's telling, see, there's a few. Okay, I had to go to 9 days. My apologies. So here are some that still offer that 20-cent net credit, but we're not seeing the 40 cents. We see 135, 37-cent net credit, but we're not seeing higher. Why aren't we seeing more spreads? Because in order with this probability range, the positions that match the criteria would be closer to the current stock price. And see, this isn't that far away. It's a 111 to 109 on lows. The stock's trading at 114. Okay, so we've got a stock trading at 114. We're looking just 3 points out of the money. We do still have an 85.2% theoretical probability, and we're getting 23 cents. This is not a bad trade. But again, you're only 3 points away. A lot can happen in 8 days, especially since consider the stock's already down 3 points today. Okay? Going further out in time, we can go further out of the money and still get the double-digit return that we want. On lows, that might be the 109, 107, more cushion. Still the same probability, but it's really close to the current stock price. Okay? So if you wanted to see other positions, still had that net credit, but we're further out of the money, what you may need to do, looking for the 85% probability first, is I may need to lower this expectation, lower it down to 10 cents. Now you say, well, what if I wanted to go further out of the money? Well, if you go further out of the money, you're going to get less net credit. Okay, so we could keep this at 85. We say, no, 3% isn't good enough. I want to go 5%. You wouldn't see necessarily the 20-cent net credits there. You've got to lower it down. You've got to meet the reasonable expectations for the strategy. So with the bull put, I want to be further out of the money for more safety. I want to do 5-day trades. You've got to lower your net credit. That Lululemon is still in there because it's more volatile, but look what happened to the rest of them. 13 cents at Autodesk, 13 cents at Shopify, FedEx at 11 cents. And these are good range out of the money. You know, 10 points out for Alibaba, almost 10 points out for FedEx. But again, we've cut the return down in half. So what makes sense for you for a weekly position? What goals do you have for the bull puts in your personal portfolio. Adjust the criteria to meet your needs, but keep them reasonable as well. Okay, so I think we took care of Richard's question. Want to encourage everyone, of course, send in your questions at any time. If you have questions about a specific strategy or a specific tool, management techniques, or more. On a follow-up from the bull put conversation, we had a comment come in from Jim who says, okay, essentially he says, well, why would you ever take an 80% loss on a spread anyway? Even if something sudden happened, you can manage the position and roll it out in time so you never take a loss. That's really tough, okay? Yes, we teach management techniques on the credit spreads, iron condors, and more. Yes, I will manage my positions when a trigger is hit. But in a sudden event, I'm just going to go to SPY real quick, and let's just go ahead and look at the chart for the last year or more, last 2 years or so. I'm just going to go to charts, sorry folks, and go to big charts. Now, of course, we know what happened in October and November. So October 5th, that was that first drop, and it happened across the entire market. But in this first few days, if I had a position, a bull put open on October 5th, and this happened, I'm likely getting close to a trigger, or I'm already near a loss. And we don't want to necessarily stay in for the rest of the way. I actually, thankfully, stopped trading bull puts after October 5th, managed my 2 positions to where I didn't take a loss on them. You're absolutely right, Jim. I was out of the money enough when it happened that when the drawdown occurred, the short option was only slightly in the money. I actually converted them both to bear call credit spreads, or I should say bear put debit spreads, using our pendulum adjustment that we teach in the webinars. And I was able to actually get a profit on those instead of being in a loss. So I changed it to a bearish spread. Now, I wasn't so fortunate. Let me just go back a little bit more. Let me do a custom range real quick here. We're going to do February 5th, February 2nd of 2018 to February 9th. No, the 10th, actually. Okay, so a real short-term custom range. Let's increase that a little bit more. Let's go to 220, so it's just a little bit easier to see. Okay, so February 5th through 9th, that was that big decline, 10 points on SPY, and it continued down 255. It doesn't look that big, but when you look at the chart, it was a big mess. That was a huge decline for a lot of securities, that February 5th through 9th. And when that first gap down happened, the market was already declining, but when that first gap down happened, my bull put credit spreads were already near a 75 to 80% loss. A little bit recovery, and then boom, it got worse. I managed those here, closed one, and managed the other one, but it still was a reasonable loss. So the idea is, at this point, why don't you just roll it out further in time, and you'll never take a loss? Well, remember, what also happened on March 21st through April 5th, and then again later in June. Let's just go to 8/10/2018. Okay, so there's that huge decline we were talking about February 5th through 9th, and then March 21st through April 5th also had that large drawdown. There was a little bit of drawdown here, but it was more controlled. Okay, but these were all sudden events. This was the China trade talk, I believe. I forget what prompted this event. But in any case, when you're in a bullish spread of any kind, of vertical spread, you're going to take a large loss. It's going to break through at least your short put strike price on this unexpected event. Let's go back to power options, and let's go to our bull put search once more, and let's just take that one we were looking at, the PLCE, the Children's Place profit and loss chart, 20-cent net credit. And we're out of the money here. The stock's at 111. So let's say there's a 10% decline overnight, pre-market or after-market hours, not even related to earnings, because we're looking specifically for positions that don't have earnings between now and expiration. But we take an 11-point drop and the stock goes down to 100 when the market opens. Okay, now you're at full loss or close to it. Maybe there's some time value left, but you're at a pretty significant loss here. So let's say the loss was only $1.65. And I did one contract to be $165. So I was expecting to make 23 cents with 13% return. That's gone. Stock's trading down here. I can liquidate right now for near the full loss, $1.65. And we say to ourselves, well, look, I'm realizing this loss. Let me just roll out further in time now with the stock at 100. And then as long as that spread expires worthless, I'll never take a loss. Okay? How far out do we have to go to get at least $1.65 net credit on this position, on our next position we're rolling to cover the loss so it can turn into a gain? At this point, we're probably going out to September. Now let's say that, assuming the stock's at 100, but let's take a look at the prices are right now for these sort of at-the-money ones, the 110. Okay, it's at 1030, and the 105 is at 860. Well, the stock's at 100. That might mean the 100 is at 1030, and the 95 is at 860. That would give us the net credit, but the stock has already fallen 10%. Something's going on. I don't necessarily want to stay in a bullish strategy at this point. And if I did, I wouldn't be at the 100 mark. I'd be looking at maybe the 90 and the 85 put. Okay, and right now even you can see this is only about a 75-80 cent net credit. With the stock fallen, we'd probably be in this range, which is about $1 net credit. That's still not enough, right? We need $1.65, so we'd be pushing it out further to maybe January, or taking a bull put spread that only had a 50 to 60% probability of expiring worthless. Yes, I could go out to January and probably get the $1.65. But when my put took the loss, that's 274 days away. A lot can happen between now and 274 days. And think about it this way. We took a loss of about 165 on the spread. Really a fair assessment would only be a loss of 140, of course, because we kept that 23 cents no matter what happens. So here's our realized loss of 140 to close the spread that's losing right now, near full maximum loss. I go out to January and I get $1.55 or $1.60. Okay? Let's say I even get $2 of net credit. So I could potentially turn this losing trade into a winner, rolling all the way out to January, getting a $2 net credit. That would be 60 cents on, say, a 5-point spread for 274 days of time. Does that match your trading plan? Where I'm going with this, Jim, is that in order to roll to never take a loss, and some educators out there will teach bull puts, the basics, just to make you dangerous, and they'll say, oh, and don't worry about it. You can always roll down and be successful. Well, you have to stop and think for a minute. I could roll this put out and down, roll it to a potentially profitable trade, hopefully in September, but more likely out to January to counter the loss I'm taking, but still be out of the money to have a reasonable probability that this spread would expire worthless. And I've turned the loser into a winner, and I've got a 60-cent net credit now, and it might even be a wider spread. It might be a 10-point spread to get that 60-cent net credit. So I'm taking on more risk. Does this return match your goals and your trading plan for 274 days? Probably not. Could it potentially turn the loser into a winner? Probably. And that's a decent enough outcome, isn't it? We would love to see that. But at the same time, it may be better just to liquidate the spread that's losing now. Take the loss of, let's say, $1.40 in that scenario, and then you know what? This was an unexpected event. The stock you were trading had something come out that was very negative to cause it to decline. You probably don't want to be in any bullish structure at this time. It might be better just to close this spread out, because you can't manage it, right? You can't convert the bull spread to a bear spread and get back to profit. You can't convert it into a 3-leg spread and get back to profit because you've taken, you're at a realized 70, 80% loss. At that point, management's almost a moot point. It's better just to close this position and take the loss, let this fall into the 10% of losers you're going to take with your trading plan with a 90, 92% success rate, and just open a few more positions with that 20-cent net credit for the next cycle, or 30-cent net credit. That might take 7 trades to make it up, but what do we know? We know we're going to take losses with that structure from unexpected events we can't control, regardless of the stock chart, company information, fundamentals, technicals, and more. It's going to happen. So instead of trying to manage it, instead of taking a whole spread out 200 days, 210 days, and staying in a bullish spread on a stock that no longer appears bullish, maybe it's better to just take the loss and continue with your trading plan, because you're going to have losses. We don't want to see the full loss, but the unexpected does happen. There's no way to avoid it in those situations. Now, all of this information, more in-depth and more, can be found, of course, on the webinars page. So go to free webinars again, as I mentioned, powerop.com/webinars.asp. Go into the option strategy section, and you can see information here. You got credit spreads, the basics. What you want to look for is 8 ways to manage a bull put credit spread from 2018, September 2018. Same 8 ways I would teach today. It walks through the different trigger points to know when to manage your bull put spread. And of course, what are the 8 ways we'd manage it? Yes, rolling the spread down and out is one of them, but not when you're at a 50, 60, 70% loss or more. At that point, what can we do? We might hold on and just wait to see if in the next 5 days the stock comes back up and our spread has a less loss, or maybe even a gain, or, of course, close the position, accept it as one of the losses you're going to take for that time period or in this strategy, make it back with the other ones. We would always want to roll the spread, adjust the spread when our trigger point is hit, meaning that when the stock starts to decline, the technicals or fundamentals we use to get into the position reverse, or the stock reaches within, let's say, 1.5% of our short put strike price. But in those events we can't control, we're not so lucky. It breaks through that short option strike price and maybe gets close to the long option. We're an 80% loss. Management is almost a moot point. Better to maybe just close the position, accept that's one of the ones you're not going to be able to repair, and make it back on other stocks that now are showing you the right trend, the right technicals and fundamentals for that specific strategy. Okay, let's see here. So that was for Jim's follow-up to Richard's question. Remind everyone again, send your questions to me at any time using the question pod there as well. Sara asked a question now. You had mentioned earlier in the presentation that the tools will show you management and rollout opportunities. Can you give an example? Absolutely. Let's just take I'm going to put in a new position, and let's just take a covered call. We'll take 2 examples. We'll do a straightforward covered call. So I'm going to go to the portfolio, and I'm just going to create a new portfolio. Okay, and we'll just call this Thursday Expiration Special. And we'll start our portfolio off with $25,000. And I'm going to set, it doesn't matter, but I'm going to set the date back 10 days or so. Okay, well, yeah, let's just go to April 1st. All right, so I'm going to save changes. Now, I'm in a married put position on stock called T-Rex, which has been all over the place. It was close to 80 almost a month ago. The stock fell down to 59 in about a 20-day period and is all the way back up to about 76 right now. But let's say a week ago, Sara, we entered a covered call on T-Rex. We bought the stock at about 72, 73, and we sold an out-of-the-money 75 strike call for, let's say, 80 cents or so. So here's the portfolio. I'm just going to enter my new covered call from scratch. It's going to prompt me, just as your broker, well, what would you like to do? Well, I purchased Trex, 100 shares on or about April 3rd, and I paid $72.75. At the same time, I wanted to keep the stock. I wanted to receive a dividend-like income, so I sold the 15-day out at that time, 75 call on Trex, and I said maybe we got 75 cents for it, 85 cents or so. Okay, so, and April 3rd. Doesn't matter, but we'll keep the date the same for simplicity. All right, so real simple entry. I've selected the strategy I want. It entered it into the portfolio. I can set a variety of different alerts here if I want to. If the stock went to X price or my position was at X profit or Y loss, you can set that in the alerts as well. Now, it shows here my original position. That's great. Stock is now up to 76.59. I'm going to get assigned today and make my expected return of about 4.2%. But we wanted to hold on to this position. We're going to have to roll this call, or at least buy it back to cancel the obligation because we wanted to stay in it. We didn't think the stock would go up to 75. It spiked up quickly. Here we are, $1.59 in the money on our April 75 call expiring today at 4 o'clock. So, as you're tracking any position in the Power Options portfolio, even just a long call, a straddle, a married put of course, but a calendar spread, you can use the More Information buttons on the side, which we saw earlier, to link to the different profit and loss chart, company information, and more. But I want to go to Position Actions and Position Analysis. The Position Analysis view gives you a breakdown of your position. You see your delta remaining, your time value remaining in price, days to expiration, next earnings date. That's kind of important to remember, May 6th. I'm going to keep that in mind for now. All right, so we scroll down below and we see the breakdown of our current liquidation value, future expiration value. And then down below, I want to keep this in mind. I'm making 4.2% if I leave it open till 4 p.m. today and a 4% return if I liquidate right now. But you want it to hang on to the stock. So you scroll down and you see the potential rollout opportunities for your position. What is this showing me? We're doing all the math for you. We originally received the 75 cents. We see our buyback cost of about 170 for our current position. I could roll to the May 80 call for 250 and still keep a net credit of 155. Now, this would be a 2% downside protection. What does that mean? Essentially, how far the stock can fall now before I start losing money on this potential covered call. This $1.55 net credit is taking into account the 75 we originally received, the $1.70 buyback, and the new $2.50 position. My new potential return if assigned is 12.4%. If the stock reaches 80, there's only a 37% chance the stock will reach that price at expiration. If you want it to be safer, here's the May 85 call shown for you, but your adjusted net credit is only 15 cents. Yes, you're further out of the money, but you're only getting 15 cents for the next 29 days out in time. And you could roll further. If you wanted more premium, we could roll to the July 80, get $4 of premium for 92 days out, and an adjusted net credit of $305, including original, buyback costs, and this would be 14.8% maximum yield or 4.2% downside protection. So all of the math is done for you. Now, it's great to see things numerically, but let's be honest, we all want to see things more visually. So as I see my rollout opportunities on my positions, I'm going to consider this May 80, rolling up to the May 80, 29 days away. I'll use the More Information button next to that potential rollout opportunity, Sara, and click on Simulate Trade. This gives you a side-by-side comparison. Your current position on the left in red, and what your new position would look like on the right in blue, and your two new profit and loss charts, the original and now my new profit and loss chart if I decided to roll this position. So we give ourselves a little bit more cushion. 29 days from now, going up to the May 80 call. We take in a new net credit of $1.55 and a new max return of $8.80 or 12.4% from $3 or roughly 4.2% if we allow ourselves to get assigned today at expiration. Now, if I wanted to do this position, I looked at the others that were there. I said, yes, I really like the 14% potential return going out in time to June, but that's 92 days away. Increasing this return by 8% to May is more along what I'm looking for, but keeping a positive net premium. From 75 cents I wanted for the 15-day trade open on April 3rd to a new $1.55 total credit going 29 days further out in time. So this is a trade I want to make. Down below, I can just put in the information's mostly filled in for me, place the roll at my broker, come back, and let's say it cost me $172 to buy back this call, and I actually got $253 for selling the May 80 call at midpoint prices. Put in my numbers, put in my commissions, and click Submit Change to Portfolio. Now here we are back in our portfolio, and what are we looking at? Our new Trex position with our May 80 call received at $253, and the effective cost per share, which is based on the buyback cost of our new call and the roll to our new May call as well, adjusted to $73.72, and that will be used for all the further analysis, profit and loss chart, and evaluating other positions as well. Okay, so that's how the rollout opportunities work. As you're tracking any position in the portfolio, use that More Information button, go to Position Actions, and then Position Analysis. You see the full breakdown of your position, and you can see even more details over here. And then, of course, you'll see your rollout opportunities down below. And if you don't like the rollout opportunities, or you expected a specific adjustment to appear and it wasn't shown, you can always go to the What If calculations up here underneath the main graph, and that'll take you directly to the profit and loss chart. And as we showed earlier, I could manually do adjustments. What would happen if I bought back X call I started with? I'd select it from the View Options menu, add in the new option I was seeing, and we'd see it graphically here as a manual adjustment to your position rather than one that was shown by PowerOptions. All right, so you can do that at any time. And if you're in the portfolio and you just want to say, hey, what would happen if I did roll this? Remember, you can always just go to the profit and loss chart and do that manually. But a faster way is go to Position Actions, Position Analysis. You'll see your rollout opportunities. Let's just click on this to refresh it. Comment from Jim on that one. Mike, where is the total return shown for when I'm rolling positions? Okay, what Jim's referring to, of course, is our original May 75 call is no longer shown here. The portfolio view in my portfolios only shows your open positions. But there are other views that we can see. So I can go to the Transactions view, and I can select to view all positions, realized gain or loss, or unrealized. Here's my realized gain or loss on that the April 75 call that we just rolled. And in the Analysis view, this shows you the total of your open positions and closed positions organized by stock symbol, so you can see the total running gain and loss. So we took a $97 loss on that April 75 call, but during that time we had a $384 gain on the stock, and the new call we just opened is at a $22 loss, of course, just based on slippage between the bid and the ask, the price I put that I got filled on at midpoint at $253. Well, the ask is at $275, so it's an unrealized. Everything that's highlighted in pink is unrealized. Let me go to one of our other portfolios that we use here. I'm sorry, let's just try this one here. Okay, so this is an older one for radioactive, but as you can see, you've got all of the closed and open positions through time that we've rolled this example. Again, everything that's highlighted is open. Everything with the white background has been closed for realized, and you can see the running total on your portfolio for the closed and open positions. And again, if you just want to see realized or unrealized, you can see it there. It's not arranged by strategy here. This one is arranged by the underlying symbol. So it takes into account any rolls, adjustments that you've made over time. Let me go back to 2018 for this portfolio. You see a little bit better. Yeah, so there's multiple rolls and adjustments that were made for these positions, and you can see the running total on the entire trade. That's in the analysis view. But the portfolios, as Jim mentioned, this just shows the current open positions. Our April 75 call was closed, so it doesn't show up in the portfolio view. It's only available in the transactions, which shows the running history, and the analysis, which shows the adjustments linked by underlying symbol, stock, ETF, or index, perhaps, if that's what you're doing. Okay, let's see here. We've got about 15 minutes left in the presentation. Once again, ladies and gentlemen, I want to give you an opportunity. If you haven't done so yet, go ahead and send a question using the question pod. If you have any questions about options basics, options advanced concepts, trade management, or more. I'm sorry, was it Tom? Tom, I'm sorry. Tom said, back on that portfolio, let me go back. Analysis 2019, I think. This was the view I think we were looking at. There it is. It says, back on the view, you show a VIX position. I didn't put the closing price in on it. Sorry, that might be part of the confusion, but it was in September we put in, I'm sorry, in August, my apologies. We put in 4 contracts of a VIX September 16 strike call. $500 cost basis for the 4 contracts was about $1.25, I guess. Okay. But Tom's question is, I see that a VIX position available or popped up on the portfolio. How do you trade the VIX? How can I trade the VIX? Okay. The VIX, the volatility index, is a completely different animal than what you may be used to with securities, stock, and options trading. What do I mean by that? Well, it's not based on an actual underlying or an aggregate of underlying securities like an ETF is. It's based on the futures projection of volatility, the futures volatility trading. So what that means is that VIX options don't necessarily follow the standard pattern that you would expect. Let's go to May 8th, a couple weeks out, and they also expire on Wednesday, so keep that in mind as well, Tom. So is there a good example here? The volatility index right now is at 1219, fairly low. Look at the call side, makes sense, sort of. Look at the puts. Let's just go to the puts only chain. The index ETF is at 1219. Well, it's an index, sorry, it's to 1219. Okay? So wouldn't you expect that the in-the-money 13-strike put, whether it's 5 days to expiration, 10 days to expiration, or 20 days to expiration, would have an intrinsic value of at least 81 cents? Well, stock's at 1219. 13 strike, 81 cents in the money. It should have at least a value of 81 cents. It doesn't. It's only priced at 42 to 68. It's below intrinsic value. How can these options, all of these puts, essentially be below intrinsic value? Because again, it's not based on an underlying asset, and it's not based on a conglomerate of assets like SPX and NDX. It is based on futures projections for the volatility, the futures on the volatility. So where this gets complicated is that you can find options, puts sometimes, calls when the VIX spikes, that aren't at intrinsic value. They'll look like an automatic loser if you bought them or you sold them and the stock or the underlying did not move. It also means that certain things such as delta and probability are also a little bit weird, not weird, but also a little bit off because it's not based on an underlying asset. So to your question directly, Tom, you can trade the VIX just like you trade anything else. If I think the VIX is stable and not likely to drop below 11 in the next 20 days, I could do a bull put spread, sell the 11 and buy the 10. But look at the prices. It's not worth it right now. And the volatility the VIX is relatively low compared to where it has been. It's been bouncing around 14 and 15. It's been holding at this 12 to 13 line. It's even dropped below 12 a few weeks ago. So the premiums aren't there because rarely does the VIX drop below 11 or 10. There's still a lot of fear out there. You say, okay, so that means I should be trading bear calls on the VIX. Not necessarily. Okay, so a bear call spread, the opposite of the bull put we looked at earlier. I'd sell maybe a 15 strike call and buy a 17. I might get a 30-cent net credit. But what happens when the VIX changes? It doesn't just go, hey, we're having a good day, let's go ahead and go up to 13. If there's bad news out there, the VIX will likely spike from 12 or 1250 up to 16, up to 1650, up to 20, perhaps. We've seen that before. We've seen it recently, December, for example. And in that case, it just blew through both the strike prices. So you can buy straddles as well, speculating on a movement one way or the other, but you really see the large gaps to the upside. You don't really see large gaps to the downside on the VIX unless we just had a large gap up. We jump up to 25, we can maybe assume that 2 weeks later we'll be back down to 18 or 19 depending on the situation. So all that being said, I typically don't, even if I have a strong opinion, a strong sentiment, I don't want to do anything that's necessarily bearish, a bear call spread. Buying a long put. Definitely would never sell a naked call on the VIX. And the reason why is because when the unexpected happens, it's going to move fast. It's going to blow both above those strikes. I might be at an 80% to 90% loss on that long put. I might be near an 80% loss on that bear call spread. How I use the VIX personally is when we're at a low as we are now, I take a very small percentage of my portfolio and I buy calls on the VIX. Out of the money calls. In this case, might be that 15 strike we were looking at. I'm probably going with the 14. So I'll take a small portion of my portfolio, look for the out of the money call that's around $1 premium, and I'll only buy a few contracts. Why? In case February 5th to 9th happens, in case October 5th happens again, in case March 21st to April 5th happens, what were the volatilities on those days? Let's take a look. I'm not on my account. I'm on the trial account, so I can't go back more than 3 months. Okay, no problem. Let's go ahead and pause that for a minute. Pausing the screen for a second, ladies and gentlemen. Bear with me here. Log back in on my personal account that has access to the full history. We'll go back to the VIX. Yes, you're not seeing me do this just because I didn't want to show me logging in. All right, let's go back to the puts now again. And let's go back to February 2018. And I had calls on the VIX that I bought in January. Remember, the first month of 2018, January, was very, very strong, very successful. And then we got walloped, February 5th through 9th. So the VIX had just jumped on February 2nd. Let's go back the previous day. It was at 1347 on February 1st. One more look back. My apologies. Yeah, 1354. Okay, so we're at around the 1350 mark here, January 31st. And then again, what happened on February 5th? The start. We saw it go up to 17 the day before. 37.32, up 20 points. Long calls would have been great. And in fact, the long calls I bought in January for February expiration more than countered the loss I took on my 2 diagonal spreads and on that bull put spread, the one I didn't manage as well. Yeah, everything I was bullish in took a big hit. Not my married puts because they're already limited risk, but that's what you see. So it's sudden and it's unexpected. So regardless of how good you think the market's doing, how stable the VIX is, I would never recommend selling bear calls or buying puts speculating it's going to go lower when we're near this low. Now, of course, at this point, what do we know what's going to happen? Well, we continued on. February 9th was essentially the end where things started to turn. We're still at 2906. Where were we 10 days later? Let's go to February 19th, or February 20th, why not? Volatility index here was down to 2060. So once you have that large spike and you see things settle, that might be the time to start doing bear call spreads. Not now. Not when you think it's stable, because when the change happens, it's going to happen fast. Let's go to March 20th, 2018. This wasn't as big as a move naturally, but this started the trade war talks and everything, I think, is when this one happens. Let's go to March 17th, 2018. Here we are again, 1343. Going into expiration the next day, unchanged, 1342. Starting on the 21st of Monday, still not bad. Oh, I'm in May. My apologies, Lee. I'm in May. Sorry, thank you. Thank you, Jim. Pointed that out. I wanted March 2018. I am really sorry. Let's go to the 19th. All right. It was pretty high. It started to move up with the trade war fears. So you see, we're already 3 points above. So back a few days before that in March, you thought things were settling. We're around 15. You say, hey, let me sell a bear call spread at 2022 for some reasonable premiums. Well, still looking pretty good. Now we're at 19. Eesh, getting close. Next day, 18. Not bad. But remember, this is probably a couple days out, and it's stabilizing a little bit. There we are, 23.34, 30% move. Even if you think that everything's recovered, February was in the past, that happened, we're a month later, everything's looking stable, something new economically or something new comes out, and that's when the VIX spikes. And of course, at the same time, we were talking about it, here we are on the puts. These puts are looking a little bit better now. Is it time to do a bull put spread? Well, what's going to happen 10 days later? Okay, let's go to April 10th. Oh, sorry, April 10th, 2018. Just a guess, I'm not even sure. We're back down to 2047. It's moving back down historically, okay? So that's sort of the trade-off there that you see. So again, while you saw VIX positions in there, in that portfolio, it's not that I consistently trade the VIX as a strategy or trade only the VIX. I'm one of those people that doesn't trade just SPY or SPX even with a portion of my portfolio. I go based on the criteria that I'm looking for, and if SPY, SPX comes up in that criteria for a spread or a condor or something along those lines, I will trade it. But I don't constantly play one single security. A lot of investors do, and they're very good at it. A lot of my PowerOptions subscribers do that, and they're very good at it. I personally just don't. But the VIX is one of the ways I use to hedge the portfolio, taking maybe 2 to 3% of the portfolio, maybe 2% or less, 1 to 2% of the total portfolio, buying a few contracts of calls on the position when it's low, when it is where it is now. And then if the unexpected does happen and the VIX spikes, that hedges the losses and can even result in a profit as well. And if it doesn't do what I want, and the calls that I bought are losing, I will just roll those into the next cycle, maybe 40, 45 days out in time, maybe less depending on the current market conditions as well. But again, you can trade the VIX any way that you want as you trade other securities, but remember it's very dangerous because it has a tendency to spike. So it's not necessarily the best thing to be in bearish vertical spreads regardless of how comfortable and confident you are in the market at this time. Would bear spreads have worked on the VIX over the past, let's say, 2 months or so? Let's just change our time frame to 2 months out, and we'll just use the VIX again. This is current now, not historical. So see, even here, we would have had some rough spots if we thought, hey, when this reached that 13 mark, doing a bear call spread at the 16 and 18 spread would have been good. Well, went up to 18. So it comes back down here and say, okay, this is a good time to do a bear spread or buy a put. I think it's going to go lower. Here's the time to maybe buy a put. Here was the time to maybe buy a put, not here. And not the bear spread because it suddenly snaps. Do a bear spread up here? Yeah, that might be a good idea, isn't it? Why? When the volatility spikes as high as it is, I've got my profit on my long calls. What's going to happen to the other calls I might buy to be a portfolio hedge? Now they're really expensive. When then we saw the VIX up at what was it, 37 on the February 5th through February 9th crash. Could I buy 40 strike calls or 50 strike calls even? No, they're way too expensive. So when you see it start to pull back, now might be a time to do a bear call spread. But remember, it can snap back at any time, and you can see it right here. It's at a low point now. So again, what do we think is going to happen? Well, spike might be coming, and it doesn't even have to be significant. We're not talking about it going to 37 or 40. We're talking about just going to 18. Small portion of the portfolio, maybe a long call. You could do a bull call debit spread even, maybe a diagonal. But remember, both of those are capped. If you expect that when the unexpected happens, we're going to have a run to 18, 19, 20, 25, 30. You want to leave that upside open. Okay, and that's why the long call might be better at that time. Be careful of thinking that we're in a bearish trend on the VIX or that everything is stable, because normally when you think that, there we go. Okay? All right, so that's related to how I trade the VIX, what to look out for with the VIX. There are other securities that you can use. Sam, a gentleman who usually joins us on our Friday afternoon sessions, he couldn't make it in today. He trades security UVXY as a portfolio hedge. Okay? And UVXY is a ultra, so it's a 2 times ETF. What's one of the advantages of UVXY over the VIX? For management, if you're in a short spread, bear call, bull put starts to move against you, you can go long or short the security, which you can't do with the VIX because it's an index. There was an ETN, an exchange-traded note, VXX, that I also used to use as a portfolio hedge. It reached maturity as an exchange-traded note. You know, as 3 years or 4 years to maturity. VXX no longer exists, but you have VXXB, and that's the new S&P short-term ETN. Sort of measures the VIX as well. Different price, doesn't mirror the VIX exactly, but when the VIX spikes, this is going to spike. Maybe not same percentage-wise, but it's going to move. Advantage here again is that you can trade the ETN to help with management. If something goes against you, want to go long or short the stock now as part of the management technique or role you're doing, you can do that. We can't do that with the VIX. You have to manage it with straight options. All right. So Tom, that's how I trade the VIX. And remember too, from time to time, as we saw on the chain for VIX, you'll see things that don't make sense that you'd expect to see on a standard option. You'll see puts at times or calls at times, that aren't priced at intrinsic value. Okay, I fell prey to my own thing. When you're looking on power options for an index, SPX, NDX, and so forth, its notation is a $sign ahead of it. Got caught there myself. So, but again, when you look at the chain for the VIX, just remember that at times you will see things that are not at intrinsic value for the volatility because of the movements. Right now you saw puts that were 2 weeks out, 3 weeks out in time that were not at intrinsic value. And when the market spikes, you might see in-the-money calls that aren't at intrinsic value as well. All right, well, ladies and gentlemen, here we are at 1:03 p.m. Eastern Time. I don't see any other questions that have come in. Of course, I want to remind everyone that the market closes today at 4 o'clock. So if you have any adjustments you need to make sure that you do those before then. Just want to remind everyone as well, today's material, Today's material are my thoughts on your questions to help enhance your options knowledge and education. Any stocks, ETFs, or strategies mentioned are not direct trading recommendations or suggestions, just my thoughts on your questions and how I approach the market. Options do involve risk and may not be suitable for all investors, so make sure whatever strategy you're doing or applying or researching that you practice proper position sizing, so even if the worst occurs and you do take a loss, you're only taking out a small portion of your portfolio. Never put all of your eggs in one basket, especially with leverage positions such as options. If this is your first time joining us or watching one of our webinars, and you're interested in the capability of the search tools which we illustrated for bull puts, but you saw we support over 23 other strategies, those portfolio tools to help you track and manage your positions, or some of those historical views you saw, looking at the chain or other historical testing that you can do and strategies. Remember, you can take a 14-day free trial to Power Options at any time. Just go to PowerOp.com, put in your name and email address. No credit card is required. You'll have access to all the tools, including 3 months of the historical use, to see how the historical tools can help with your back testing or paper trading as well. And then the subscriptions, monthly subscriptions after that, start at just $40 per month for different levels of service, whether you want to go delayed, real-time, or more. Of course, if you're interested in other information, you can check out our blog at any time, blog.powerop.com. We illustrated today the webinars page a few times. Remember, it's a public page. You don't need to be logged in to access. Just go to powerop.com/webinars.asp. And of course, you can always find us on YouTube as well. Just search for Power Options. Now, if you do think of any other questions before 4:30, 5 o'clock p.m. Eastern Time today, you can always call us during market hours, toll-free inside the U.S. at 877-992-7971. If you're outside the continental U.S., you can reach us at 302-992-7971. Also, send me an email at any time to support@powerop.com. And those of you that are current subscribers or on your trial, remember you can schedule a free coaching session at any time. Just under the main home tab, click the free coaching link, and you'll see the scheduler appear where you can pick and choose which time you want to have a coaching session with either myself or Ernie as well. Ladies and gentlemen, thank you for joining me today. Thank you for your questions as well. Have a fantastic extended weekend. Make sure again to close your positions before 4 p.m. Eastern Time today, Thursday, April 18th, as the market will not be open tomorrow. And I look forward to seeing you next week for some of our other online live presentations for Power Options for radioactive trading, or perhaps even on our next open forum discussion, which will be Friday the 26th, regular scheduled time, 4:30 p.m. Eastern. Take care, everyone. Have a fantastic weekend. We'll see you soon.